The Fed rate cut in September was half of a point, but failed to make a short-term difference on mortgage rates. They actually went up. But experts say there is hope on lowering those interest rates with another Federal Reserve cut. The Federal Reserve's interest rate has been going up steadily over the years, an attempt to slow down the inflation rate. Now there is a second interest rate reduction since September. That could eventually mean lower interest rates on car loans and new mortgages and credit cards. But when?
So a single quarter point rate cut isn't going to be impactful on the household budget, but a series of rate cuts taking place over the course of the next 6 to 12 months, the cumulative impact of that could be.
Greg McBride, a chief financial analyst for Bankrate.com, also explained why interest rates on mortgages have recently ticked up to around 7% in the last several weeks since the last Fed rate cut in September.
The reason is mortgage rates are based on long-term rates. They're not based on the short-term rate that the Fed controls. Mortgage rates have been on a steady uptrend, and that's because we've had a better tone of economic data. And in more recent weeks, investors are growing increasingly concerned about the extent of government borrowing. That's pushing up long-term interest rates and taking mortgage rates along for the ride.
That concern of government borrowing and the unlikelihood of a recession will create a slower process for rates to go down. But experts at WalletHub say auto loans and credit card interest rates have seen a continued decline.
So people who are taking on new credit card offers and who have current credit card debt are saving a lot of money from these rate cuts so far and will continue to do so.
And even though this cut comes just after the election and a Trump presidential victory, experts are reminding that the Federal Reserve is independent of political parties.
Making decisions based on economic indicators, not any political short-term causes.
The average credit card interest rate is down, but it's still more than 20%. If you're using a credit card with high interest rates, the best advice is to pay off your balance monthly. Rob, Judy, you can also try to transfer balances to a 0% interest rate card to pay them off, but you have to be aware of those too. Those offers are usually temporary, and guess what? The interest rate will
go up.
Go up. There's usually a fee, but it's sometimes a good way to get that 0% and pay it off.
It's one strategy.
Yeah. Watch breaking news on YouTube. Subscribe to ABC7 Chicago Eyewitness News.